Hi there, and welcome to the Projects Distilled YouTube channel where we talk about all things project management. I am really glad that you're here. Today, we are going to talk about one of the three major pillars of project management, and that is budget. I cannot tell you how many naive budgets I have seen put across my desk in my career. There is so much more that we can be doing as project managers. I want to keep you from making the mistake of putting together a budget that will be laughed at or at least snickered at by our finance partners, by leadership. Budgets have a lot going on beneath the covers. In this video, we are going to kind of lift those covers so that we can see what's going on so that you can create a more sophisticated, more accurate, better project budget. Let's dive in. By the end of this video, you're going to have a much better idea how to build a better, more sophisticated budget. But to get there, we need to talk about some basic concepts first. The first thing we're going to talk about is fiscal year. Doesn't matter if you're working for a private institution or a public company, all organizations have what is called a fiscal year. Oftentimes that corresponds with a calendar year, meaning the start of the year is January 1st, the end of the year is December 31st. But that is not always the case. Many companies will have a fiscal year that is offset from the calendar year. So one of the core things that you need to know and understand is what your organization's fiscal year is. Understanding what your organization's fiscal year is critical because that's how budgets are developed. Budgets are often developed for a fiscal year. They're often also developed for quarters and sometimes months. Understanding the boundaries that your budget sits within is critical, especially if you are going to move your budget. If something happens, you may cross a fiscal year boundary. That's a big deal. You need to understand all of the implications behind that. Best way to find out what the fiscal year is ask someone who's been there a while at your organization. Second principle you need to understand, capital versus expense. So often projects are expensed. That means that the month in which the cost is incurred, that money leaves the books of the organization and is never thought of again, except it shows up on an expense sheet on an accounting document. However, some parts of a project or the entire project may be capitalizable or capitalized. What this means is the budget does not just leave the books right away. It may be kept on the balance sheet for 1, 2, 3, 5 years, depending on how the organization is set up. And understanding whether or not your project is capitalizable and whether or not there are pieces within your project that can be capitalized is essential. For example, if you're working on building out an office space, much of that is going to be capitalizable. If you're creating new software from scratch, much of that is going to be capitalizable because you're building something, you're making something. If you are taking software that you bought from another company and implementing it, probably not capitalizable. If you have to buy hardware to support the software that you purchased, that might be capitalizable. So understanding what that means and what the rules are for what your company capitalizes and what it expenses is important. Ask your finance partner, ask a colleague, ask your manager about what the rules for capitalization are for your project budget. The next important principle to understand is depreciation. Now you may hear the word depreciation. You also may hear the word amortization. It's important to know the difference between those. Something gets depreciated if it's been capitalized. And in our example that we're going to do here in just a minute, we're going to show some depreciation on some hardware and how that impacts the total budget that you are presenting. The easiest way to explain this is if you're buying a $100,000 piece of hardware and it's depreciated over 3 years or capitalized over 3 years, each year or each month, really, you get to write off 1/36th of that amount. Or if it's annually, the annual write-off would be 1/3 of that $100,000. So it's a very simple math problem, but you need to understand what can be capitalized and what can't. Your accounting team is going to have the rules for that depreciation. But that can make a big difference in the budget that you ask for. So it's important to know those rules. Amortization, on the other hand, is the amount of a contract that is written down every month. So let's say for your project, you sign up for 2 years worth of a SaaS service, and that SaaS service costs you $200,000. The amortized amount each month would be $200,000 divided by 24. That gives you the monthly cost. And that's the way most organizations look and choose to look at the expenses related to those types of contracts. So your project budget may say, hey, I need $200,000, but really there's a monthly cost associated with that. And that can work to your favor when you talk about the budget that you need for your project. One last principle to go over before we dive in is blended rate. Most of the organizations that I've worked for have not used the cost per employee as a way to track project costing, but I know that there are a lot of large companies out there that do use employee rates. So if you have 10 people on your project, you need to find out from your finance partner or your accounting partner what the blended rate is for each of those employees. The blended rate is the salary plus the benefits plus any other employee costs. And then it's kind of generalized over classifications of employees. So there might be an engineering rate or a accounting rate or a project manager rate. So if you have to account for your own costs, your rate may be $100 an hour. You're not getting that in your pocket, but that's what it's costing the company in a blended way. And that's also kind of averaged out over other people who have the same role that you do. That's a way to protect the privacy of specific salary information for somebody. But understanding those blended rates is essential to being able to estimate the costs for internal resources on a project. Okay, so those are the principles you need to understand. Now let's take a look at budgets. So take a look at this budget. I can't tell you how many times I've seen budgets like this put in front of me saying, hey, boss, I've come up with the budget numbers for my project. But look at these. They're really naive. For vendor costs, and we're going to assume that this is kind of an implementation, they're going to help us to do all of the organizational readiness and get this new software piece employed by the company. They want to charge $120,000. Okay, great. But there are other pieces to this that you need to understand. Like, is that $120,000 have to be paid up front, or is it paid based on milestone? Hopefully, if you're smart and your vendor management skills are right, those are based on milestones that the vendor organization achieves. So there's more information that needs to be had there. What about these contractor costs? $211,000. So that's great, but how is that broken up? Is that 10 contractors? Is that 2 contractors? And what are their skill sets? What are their rates? There's a lot more digging and information that should be provided as a part of that contractor information. And you'll probably be asked by management what that is, so you need to know it. Software, $366,000. So what does that buy us? Is that actually buying the software, or is that a subscription? Back when I started doing projects, it was usually an actual, you would buy that software and you got to run that version in perpetuity. That's not how it works in most cases now. Most software is now software as a service, so that's a service cost. This number actually in our scenario happens to be the cost for 3 years of a software as a service contract. So yes, it's $366,000, but the first year is really only 1/3 of that. When we amortize it, the number changes quite substantially. So we're going to talk about how to show that and some best practices around showing some of the software costs. Hardware costs. The last 2 organizations that I've been with had almost no hardware costs. They were all virtual. But I know a lot of organizations still have those, so we're going to assume that that's some server cost and some maintenance. But the cost for the servers can be capitalized. Probably, depending on the rules, but for this scenario, we're assuming that it can be capitalized. But there's usually also maintenance costs that's about 20%. That number has to be broken out. See, not all dollars are the same. We need to get down and double click on some of those details. So yes, that's the quote that the vendor provided. And yes, I know that took work for you to get that, but there's still more work to do to make that budget number really understandable by management. And on here, there are no personnel costs. A lot of times that's not included in project budgets, but we're going to include it in our scenario. So what we're going to do now is we're going to take this simplified budget that you presented to me, and I'm going to show you some best practices around how to make this more detailed, easier to understand, better for the finance people. You can have richer conversations with them. They're not going to come to you with 1,000 questions because you've already answered 950 of them. Let's take a look. The first best practice that I want you to take away is that for every line item you have in your budget, you should probably have a budget sheet set aside for that. Now, it can all live within one spreadsheet, but what I do is I put a tab for each of the lines. So if you look at this spreadsheet, you're going to see multiple tabs. You can see our original budget here, and then what I do is I create a roll-up tab that has all of our numbers, and here you can see each of these sheets contains additional information. Let's go through them line by line. So let's look at the software tab first. What we know is that somewhere you've got a quote from the software vendor for 3 years of service, 36 months, and that it's about $366,000. So what you need to do first, if they haven't done it on the quote, which they probably have, is a per user number. So let's say you've got 1,000 people in the company and they give you a per user number of $10.16. Well, $10.16 times 1,000 users times 36 months gives us that $366,000 number. It's actually slightly less, but that's the number that I'm basing the scenario on. So for the way I would budget, if it's a 4-month project, I'm making an assumption there from September through December, and we're assuming a fiscal year in the scenario of January 1. So it's the same as the calendar fiscal year. That's often the case, but not always. Just you need to be aware of it. So for the last 4 months, what is the cost of that software? Well, we're not actually going to buy that software or sign that contract until we're a little bit farther along in the project, because it would just be sitting there and we'd be wasting that monthly fee because people aren't using it. We're actually going to sign it a month before the go live so that we have time to then get the software ready to go for everybody, but not before then. So in the 4-month window of our project, the first 2 months, there's actually not even a software cost. And for the software cost for those 2 months, it's really just 1/36th for 1 month and another 36th for the next month. And so that $366,000 number drops dramatically. We're looking at just over $10,000 a month. Now, I would never just say, hey, our total software cost is $20,000. That's not a fair representation either. But during the project window, that's what the software is actually going to cost. And that's what it's going to cost this fiscal year. When you talk to finance people, they're very interested in the fiscal year that something falls into. So that $366,000 becomes $20,000 this year. And if you look lower on the sheet, it's very easy to calculate what the next fiscal year cost is going to be. So just a little over $120,000 next fiscal year. So they can already put that into the budget so that they're ready for it. Total cost then is just 3 years of that number. So very easy to derive numbers, a lot richer. When you get questions from your manager or from finance, you've got the numbers at your fingertips if you do your budget this way. So there's one tab around software. Let's look at vendor costs next. So the vendor may have presented a document that says, hey, pay us $120,000 and we're going to help you implement this software and all of your users are going to love it. Hopefully that contract is a little bit more sophisticated than that. And in fact, I would strongly recommend that you tie any payment to a vendor to successful completion of a milestone. So for this project, for this scenario, I'm assuming 4 milestones. First one is completing the planning. So that's worth a little bit of money. They spent some time on that. So that's that first payment in September. The next milestone is artifacts created. So we're assuming that they're helping us to implement this and train our users. So they have to build those training documents. That's what that October payment is. November, they're doing training of the trainers. So we're assuming that for 1,000 people, we're not going to call all of them into a room to do a training. We're going to train other people and they're going to do training sessions for them. So we're going to train somebody or a couple people in legal, a couple people in sales, a couple people in finance to help train those users on the use of this software. So that's the training of the trainers. Then the final cost in December is the actual support around the go live. So we're assuming that we go live sometime in December. Now, I would actually never recommend going live in December unless it's an absolute must, because everyone starts to check out toward the holidays at the end of the month. But for this scenario, that's what the assumption is, that it goes live in December and that's the cost for December. So you can see for each month of the project, the costing is a little bit different. But that's great. With all the other costs that we're accumulating, we're going to be able to have a monthly cost for each of the months that we're engaged in the project, as well as a total cost for the year, as well as costs for the future. We're answering all the questions up front. Next tab is hardware costs. So this one's relatively straightforward, but you've got to understand the rationale behind it. So whenever you buy hardware, so let's assume it's a few servers, when you buy those servers, there's the actual cost for the server, and then there's maintenance. It's usually about 20%. So we're assuming that the cost for the servers is about $38,000 and then a 20% plus up for maintenance for 12 months on that hardware. So how did I go from $45,600 to $5,000 for the total cost for the hardware? Well, that $5,000 is not the total cost. That's the cost for the 4 months that we have it while we're executing the project. The way I get that is making an assumption, and you should verify with your finance partner what the depreciation schedule is for computer hardware. Here I'm assuming 3 years, so I took that $38,000 and divided it by 36 months and assumed that each month we're depreciating 1/36 of that. And then I took that 20% maintenance number, divided it by 12 months, and look, it's actually the exact same number, which is just happens to, it's coincidental. But that gives us about $1,260 something that goes out every month on the books related to the computer hardware. So let's look at contractor costs. Our original number was $211,000, and yes, that's the cost of the contractors, but there's more detail behind it. Somebody's going to ask you, well, what are we getting for this? What is this? So that $212,000 actually happens to be 2 contractors. One is a senior engineer, one is a less senior engineer, and they have different rates. And so what we've done in the spreadsheet is we've broken out those different rates across the 4 months that those contractors are with us. That's going to be important because you may be asked to do an accrual. So an accrual is an estimate of how much money you're spending in the month, but that has not yet been billed for. Let's say the contract vendor bills you monthly, but for the month of November, they're going to bill you on December 15th. So your accountant is going to want to know, well, how much is that December 15th bill going to be? So you need to have some estimates ready to go for accruals. Sometimes accountants take care of accruals for you. Sometimes they ask the project manager what the accruals are, but you need to know these numbers in case you get asked about those accruals. The last tab that we're going to look at that rolls up into our budget roll-up is our personnel expense. So for personnel expense, we're going to assume that we have 4 team members and we need to do some estimating. So what I recommend is to estimate how many hours each of them is going to spend per month on the project. Some are going to spend more, some are going to spend less. Build out that table so that you can see how many hours they're going to be, and then talk with your finance partner or your accounting partner to get that blended rate that we talked about earlier in the video. Once you have that, you can develop an actual cost estimate for each person for each month that they're going to be working on the project. And then you take and you roll that up. And you'll notice at the top of this sheet, within the spreadsheet, I have September, October, November, December, and total. It's the same on all of the other sheets. That way, I've got a consistent way to roll up that data on the front sheet. So each of those tabs lives in a row from row 4 down to row 7. And then also row 10 is our personnel cost, because I'm not going to include the personnel cost in the out the door expenses. So many times managers want to know how much money is going to go out the door. How much do we have to spend to get a project done? We're going to answer that in that first block from rows 4 through 8. And the answer, if you look in cell F8, you can see $356,000 there. That's how much our budget is for this fiscal year for the project. Now we know that there's additional hardware and additional software spend coming, but that's the number for this year. If we want to look at the internal spend, there it is rolled up across row 10, and then you can come up with a total project spend for the first fiscal year. So if you include internal spend, that's $525,000 spent this year on the project. What's great is then you can build out what year 2 looks like, what year 3 looks like, or you can let your finance partner do some of that. But showing the budget this way makes it so much easier to have those conversations with management and with finance. It's so much more sophisticated. You're looking at all of the challenges, you're looking at all of the rules around accounting and finance, and you're applying them to your project budget. Down at the bottom there, you'll see a list of assumptions. That shows you that you're thinking through and are at least aware of what's the limitations of your data are, that you're making some guesses as to the things that should go in there, but you're documenting them so that when your finance partner goes and looks at this spreadsheet, they'll go, oh, okay, I see what they're doing. It's not quite what we do, but I can fix that. This is a better way to budget. Now, I have seen budgets that are thousands of rows, tens of thousands of cells, and you can get as sophisticated as you need to. But if you follow the principles of breaking out expenses by tab and then doing a roll-up of that project budget, that is a great way, that is a time-tested, proven way to create a project budget. I recommend that you do that. If you found this content useful, please like and subscribe. Thank you so much for listening.